I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ross Kay from Ross Kay Realty Consultants. Welcome to the show, Ross.
Thanks, Jim. I hope this finds you well.
Oh, well, as anything can be expected here on the wet coast. Ross, the Canadian Real Estate Association said it's been a positive year, October to October, but they really are picking at straws here, aren't they?
Yeah, if you notice the press release that went out on Monday, they are so fervent about releasing a positive show of housing data. It was not better displayed than it was yesterday. So they came out with the claim that October 2015 was 0.1% busier than it was last year in October. In other words, they claimed that there was 0.1% more homes sold in October of 2015 than there were in October of 2014. When you go back and look at what they reported last year and then compare that number with the number they reported this year, you'll see that the sales were actually down negative 0.1%. The negative number is so important to real estate agents to allow them to sell houses or to stop them from selling houses, is that they'll do anything in their power to present the market as a positive instead of a negative. So behind the scenes, if you look at the data that the Canadian Real Estate Association has released itself in the past, you'll see that what they had to do was go back in and take sales off of Quebec and Ontario for 2014. So in other words, they went back and negatively adjusted 2014's numbers so that when you add them together, the numbers for this year would beat them. But even going to those extremes, they were still only able to claim a 0.1% increase. I think your listeners should understand that if they're going to claim a 0.1% increase, there must be a psychological barrier that they're trying to maintain. And what they are is they were trying to maintain the illusion that the market is busier than that it was, so that people would still go out and buy homes in November. This real estate market is correcting, Jim. It's correcting across Canada. The only holdout right now is British Columbia. Many of your readers, or listeners, will have read the CMHC's release of the HPAA, House Price Analysis Assessment and Analysis Assessment. That was something that CMHC released last November. We may have talked about it back then. It was CMHC's response to growing concerns over the Canadian housing market being overvalued. CMHC publicly went across the country last year telling everybody that the housing market was not overvalued, and they used the HPAA as their proof. Well, what happened in November of this year is the HPAA no longer exists. The word price has been dropped from the report. It has been rebranded under the name HMA, Housing Market Assessment. CMHC has been caught mispresenting data that has been supplied to it, and that they know that they've been caught now. CMHC, I spoke with them on the phone. They are fully aware that the housing market numbers that they have for some CMAs in Canada are simply wrong. They're also now aware that the resale housing numbers that are quoted in all of their housing reports, everyone from 2002 forward, were not resale housing housing numbers. They were housing numbers released by the real estate boards, which are not restricted to resale homes. So I think what you're going to find either in November or December, CMHC is going to now stop using the word resale homes in their housing market outlook, their housing observer, their housing now reports. And that will be replaced by some other term, but it will no longer reference resale home. Why this is important is that for years, Canadians have relied upon CMHC's word that the numbers they were reporting for the resale home market were resale homes, when in fact they weren't, because real estate boards across the country do not report resale homes. They report any sales that their members have made. Whether it is a brand new home or a resale home is irrelevant to the real estate board. The numbers they release are the sales of their members. So it does not represent resale homes. If you look over at Calgary, a point of reference in your radio show over and over again over the last while, you'll wonder why the housing prices only dropped so little, even though market activity is off by 36%. The reason why is simply because more new homes are included in the resale home count. That's the only reason. Your resale market always follows the new home market, as long as you're measuring the prices of the appropriate category of homes. CMHC has never done that. CMHC does not have that number. CMHC uses the StatsCan CMHC New Home Price Index, which in no way reflects what the builders are selling their homes for. When you look at what the builders are selling their homes for, you'll see a direct parallel against the resale numbers released by the real estate board. So there's one. CMHC has revised its newly created, has not even been 1 year old, house price analysis assessment. They've dropped the word price, and now they're calling it housing market analysis. I don't know if we talked about this last time or not, Jim, but I mentioned if the Liberals were going to win the election, that in all probability CMHC would go back in and try to cover up some of the things that they had told the Conservative government. Whether it's coincidence or it's foresight on our intelligence, but CMHC did exactly that by changing the HPAA to the HMA, and no longer is the word price appearing in that report. Another convenient occurrence is the Mortgage Brokers Association. I don't know if you interview a representative from the mortgage brokers or not, Jim, do you?
I do talk to a mortgage broker, yes.
Okay, so the question would be is ask him if he is a member of CAMP, CAAMP. Because what you're also going to find is they just recently, a few days ago, also rebranded. And now they're rebranded under the Canadian Mortgage Professional headline. So the CAAMP designation, CAMP, which was the body who released all those reports we talked about on your radio show, the ones where they had the absurd comments about 45% of all home purchases being to first-time buyers. Oops, they've just changed their name. They've changed their name because clearly the absurdity of that report with 45% first-time buyers destroyed any credibility that organization had. They've changed their name, coincidentally, just after the election. These are the types of problems that your readers or your listeners are encountering when they're dealing with anyone associated with the real estate market. They're dealing with people who want to make claims to sell their goods and services instead of presenting the market in an honest and open way. When we look at British Columbia, because this is important to everyone who lives in British Columbia, the British Columbia real estate market has been accelerating for 33 consecutive months. What that means is that people in British Columbia are selling their homes, staying in their homes a lesser and lesser period of time before moving. So when the current cycle started in British Columbia, it started way back in, I don't want to make a mistake here, Jim. It started way back in June of 2013. That's when your current trading cycle was established. From June of 2013 till today, your housing market has gotten busier in British Columbia. What that means is this. Back in June of 2013, people were moving every 10.84 years after they were in their home 10.84 years. So you had to live in your home for almost 11 years before you moved. What's happening in October of this year, things have gotten so busy, people are trading their houses more rapidly, that has dropped to 7.38 years. So you've seen your market accelerate that rapidly over those 33 months. There is only a slight slowdown. Now, it's still a positive, but it's a slight slowdown that was recorded in October. So it's possible early 2016, your market will finally begin to correct, but it's not on pace that way. I think most of your listeners will be shocked to understand the average selling price in the province of British Columbia is $623,421 in October. That is what the average selling price of a BC home would be. That is an increase of 10.11% over the last 12 months. If we project that through to the end of the year, the average selling price of a home in British Columbia is almost going to reach $630,000. And all of your listeners are going to be shaking their heads saying, wow, how can anybody afford a home that is $630,000? Well, it's really quite simple. If they purchased the same home seven years and 4 or 5 months ago, they would have purchased it for somewhere around $445,000. So they've seen basically almost 100, by the time the year rolls around, they're going to see basically $180,000 gain in their property over that period of time. That's why they can buy a house that's worth $800,000, because the $450,000 house they bought 7 years, 4 months ago is now worth $630,000. This is why all of the real estate numbers that the real estate boards release as to price are totally irrelevant. All they're doing is measuring the amount of equity that's being passed forward from one house to the next. And that's how someone in Vancouver can afford to buy a $1.2 million house. It doesn't have to be offshore money, although that is happening to a certain degree. We figure about 2.8% of the sales in Vancouver CMA are being caused by foreign buyers. But that also means the regular Canadian who's lived in Vancouver for the last 10 years can move from his house into a $1.2 million house by increasing his mortgage $300,000. His house could already be paid off. So he's only assuming a mortgage that some first-time buyers are acquiring. That's how the home prices increase the way they are. Not because the markets are crazy, not because people are all of a sudden are making $500,000 a year and can qualify to buy a $1.2 million house, but rather simply because they built up equity in their house, and that allows them to move on to the next.
We'll have more with Ross Kay right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with real estate consultant Ross Kay. Ross, what happens if the U.S. decides to hike interest rates in December? How will that affect the Canadian real estate market?
Well, I'm going to stress that the market turned negative in October. So what that means is that the Canadian housing market began to contract this October. It had started to contract last October, but then the government, the Minister of Finance, and the Bank of Canada reduced interest rates in January, which caused the market to rebound. It caused the Canadian market simply to return on the pace that it was before it had started to slow down. Normally, when the fear of an interest rate increase happens, in other words, let's say the week before the rate increase happens in the United States, the realtor community and the banks in Canada will start to tell everybody, oh, you better go out and buy your house right now because the interest rates are going up. This technique has been used for over 30 years by organized real estate. You can go back and check thousands of press releases issued by real estate boards across Canada over the last 30 years, and you're going to see that one consistent message: fear. Interest rates are going to go up, so you better go out and utilize that pre-approved mortgage you have, which is a quarter of a point lower, before the interest rates go up. So historically, Jim, that has always had a positive bump in sales volume. What it does is it brings sales forward that would have happened 2 or 3 months later into this month's sales. Since though the people that are most impacted by that are first-time buyers, what that means is you'll get a bump in first-time buyers entering the market, and that has a causal effect on the sales chain where 2, 3, 4, 5, 6, 7, depending on what real estate market you're living in right now in Canada, that has a subsequent bump in the number of sales that are possible in that market. So historically speaking, in all fairness, you have to say that normally when there is the fear of an interest rate increase, sales are pushed forward earlier than they normally would be. The subsequent fallout is, if there is not a subsequent fear or a subsequent decrease going forward, the real estate market is negatively impacted by those sales happening earlier. Real estate agents like it because it allows them to say the market's busier than what it's than really what it's showing, because they're moving those sales forward a couple of months. I think what you're going to see this time, though, Jim, is that probably the first time in 30 years that we're going to see consumers withdraw from the market. When we watch our engagement index, and that's our measure, our forward measure of the housing market, it's a forward measure of activity. Both the first-time buyer measurement, which is the part of the market that was the part of the buyer base that began removing themselves from the market back in May of 2013, those people are probably not going to be in a position to capitalize on the fear tactic that's going on. They probably are not going to buy into it. They're going to hear the fact that interest rates are rising, and they're probably going to hear a lot of commentary that they may have listened to off to the side that we're in for a very long period of rising interest rates. So I suspect this time around, the fear factor normally used to bring sales forward will not work. What you're going to see the moment those interest rates rise is the new reality in Canadian real estate. And that is a new reality that we haven't seen in over 35 years. We're going to see people renewing their mortgages at an interest rate higher than the last time they took it out. So you have a 5-year mortgage, and you took it out at, say for the sake of the argument, 3.8%. A year from now, it may be up for renewal, and you may find yourself into a 4% mortgage renewal. That hasn't happened in 35 years, Jim. In going forward, if we assume the economy recovers at all over the next 1 or 2 decades, you're going to see interest rates consistently increase over that period. Now, I don't suspect we're going to see 10% interest rates, but we certainly are going to see the normalized 6% interest rate return. Canadians are not prepared for that. They're not prepared for being faced with a mortgage renewal where they're going to be paying higher carrying charge, because we haven't seen that in 35 years. That is the new reality of the Canadian real estate market. So the second those interest rates bump in the States, there will be a corresponding bump in Canada. The Bank of Canada has no control over interest rates. It's determined by the bond market. So even though the Bank of Canada may hold its 5-year rate at 4.64%, the banks who have been lending 5-year mortgages at 2.3% 7% are going to have to increase their mortgages to 3.2%. So even though the Bank of Canada doesn't raise its rate, the ability of the consumer to go out and access these highly, highly discounted rates quickly evaporates. And how quickly that 2% discount, in other words, you can get a mortgage today, a 5-year term, basically at a 2% discount over what the Bank of Canada is saying the mortgage rate they've set it at. You qualify at the Bank of Canada's mortgage rate. So you're qualifying at 4.64% on a 5-year term today with CMHC or with any bank. That's basically what you're looking at. But even though you're qualifying at it, you're finding, but my mortgage payment is lower because I have an interest rate of 2.64% for the sake of the argument. That 2% spread is what evaporates. And it evaporates as quickly as the U.S. interest rates increase. So all this talk about the Bank of Canada not raising their interest rate is foolish because we have 2 full % of increase available simply to be eaten up from the current discounts. So I think this time around when we see a bump of interest rates, that will be the beginning of the new reality of the Canadian housing market, and even the sole survivor, British Columbia, specifically Vancouver, they will not be able to withstand that because first-time buyers will no longer be able to afford to enter the market at the asking price that first-time buyer houses are being sold at.
Ross, thanks a lot for chatting with us.
Thank you, Jim.
My guest has been Ross Kay from Ross Kay Realty Consultants. His website, rosskay.com. You're listening to HowStreet.com Radio. Our popular YouTube channel is Talk Digital Network. Find us on Twitter at Talk Digital Net. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.